In 2008, the stock market collapsed. The Dow Jones lost more than 50% of its value. Panic spread across Wall Street. Investors sold everything: retirement accounts, blue-chip stocks, their entire portfolios, just to stop the bleeding. But Warren Buffett did the opposite. He wrote an op-ed in the New York Times titled, "Buy American. I Am." While the world was selling in fear, Buffett was deploying billions of dollars into beaten down American companies. That wasn't luck. That wasn't a gut feeling. That was the result of a very specific mental framework, one that Buffett has spent decades building, testing, and refining. Today, we're going to break down that framework. How does Warren Buffett separate emotion from decision-making? And how can you start applying these same principles to your own investing? Let's get into it. Before we talk about Buffett's solutions, we need to understand the problem. Human beings are wired for emotion. Our brains are designed to react fast, to danger, to opportunity, to social pressure. That was useful when we were hunter-gatherers. It is not useful when you're managing a stock portfolio. There are two emotions that destroy most investors. Fear, which causes people to sell great companies at terrible prices during market downturns. Greed, which causes people to buy mediocre companies at absurd prices during bull markets. Research from behavioral finance shows that the average retail investor consistently underperforms the market, not because they pick bad stocks, but because they buy and sell at the wrong times, driven entirely by emotion. Buffett has famously said that investing is not a game where the person with the highest IQ wins. It's a game of temperament. The ability to control your emotions while everyone around you is losing theirs. That's the real edge. But how do you actually do that? That's where the mental framework comes in. The first pillar of Buffett's mental framework is this: never think of stocks as ticker symbols. Think of them as ownership in a real business. This sounds simple, but it changes everything. When most people buy a stock, they're buying a number on a screen. When that number goes down, they panic. When it goes up, they get excited. They're reacting to price, not value. Buffett approaches it differently. When Berkshire Hathaway buys a stock, Buffett thinks of himself as buying a piece of a business, the same way you think about buying a local restaurant or a manufacturing plant. If you owned a bakery, and 1 week foot traffic dropped because of a snowstorm, would you immediately sell the bakery? Of course not. You'd understand the underlying business is fine. The short-term numbers don't reflect the long-term reality. Buffett applies this same logic to publicly traded companies. When Coca-Cola's stock dips during a market correction, he doesn't ask, "Why is the price falling?" He asks, "Has anything changed about the fundamental business?" If the answer is no, if people are still buying Coke, margins are intact, the brand is still dominant, then the dip isn't a threat. It's an opportunity. This mindset creates an emotional buffer. Because you're not reacting to noise. You're anchored to something real. Now here's where it gets really interesting. Buffett didn't invent this idea, he learned it from his mentor, Benjamin Graham. And it comes in the form of a parable. Imagine you have a business partner named Mr. Market. Every single day, Mr. Market shows up at your door and offers to either buy your share of the business or sell you his share, at whatever price he feels like that day. Some days, Mr. Market is euphoric. He's convinced the business is worth a fortune, and he quotes you a very high price. Other days, Mr. Market is depressed. He's convinced the business is doomed, and he offers to sell you his share at a very low price. The key insight is this: you are never obligated to trade with Mr. Market. You can ignore him completely. You only step in when his price is either ridiculously high, in which case you sell, or ridiculously low, in which case you buy. The mistake most investors make is that they treat Mr. Market as a wise guru. They follow his mood. They let his daily swings dictate their decisions. Buffett treats Mr. Market as an emotional, irrational counterparty, useful only when his irrationality works in your favor. This mental model is one of the most powerful tools in investing. It reframes market volatility not as something to fear, but as something to take advantage of. The market isn't smarter than you. Sometimes it's just having a bad day. The next layer of Buffett's emotional armor is something he calls the circle of competence. The idea is straightforward: only invest in businesses you genuinely understand. Why does this matter emotionally? Because when you truly understand a business, its model, its competitive advantages, its risks, you can remain calm during turbulence. You know what you own. You know why you own it. And you know when the market is being irrational versus when there's a genuine problem. Buffett famously avoided investing in technology companies for most of his career. Not because he thought tech was a bad sector, but because he didn't feel he could accurately predict which companies would win or lose 10 to 15 years out. That was outside his circle. When the dot-com bubble burst in 2000, Buffett was heavily criticized for not participating in the tech boom. And then, when the bubble collapsed and wiped out trillions in value, his discipline looked like genius. He didn't avoid tech stocks because he was afraid. He avoided them because he was honest about what he didn't know. That intellectual honesty is itself an emotional discipline. It keeps you from making bets driven by FOMO, the fear of missing out. Here's a mental exercise Buffett has shared in talks and letters that I think is incredibly powerful. It's sometimes called the 20-slot rule. Imagine that when you're born as an investor, you're given a punch card with 20 slots. Every time you make an investment decision, every buy, every sell, you use up one slot. And when all 20 slots are gone, you're done. No more trades for the rest of your life. Think about how differently you'd behave. You wouldn't react to every market swing. You wouldn't buy something because a friend told you it was going up. You wouldn't sell a great company because of a bad quarter. You'd be intensely deliberate about every single decision. This rule isn't literally how Buffett invests. He makes more than 20 moves over a lifetime. But the mindset behind it is central to his approach. The goal is to dramatically raise your threshold for action. To build in a bias against trading. Because in investing, unlike most areas of life, activity is not a virtue. The urge to do something, to react, to adjust, to trade, is almost always driven by emotion rather than logic. The 20-slot rule is a mental fence that keeps emotion out. Everything we've discussed comes together in this final concept, intrinsic value. Buffett defines intrinsic value as the present value of all the cash a business will generate over its remaining life. It's not a precise number, it's an estimate. But having that estimate changes how you behave. Here's why. If you believe a business is worth 100 Indian rupees per share, and the market is currently selling it at 70 Indian rupees, you have a margin of safety. You're getting a rupee of value for 70 paise. You can buy with confidence, not based on a hunch, but based on a calculation. And crucially, if the market then drops it to 60 Indian rupees, you don't panic. In fact, you might buy more, because the math says you're getting an even better deal. On the flip side, if the market prices that same stock at 130 Indian rupees, well above your estimate of intrinsic value, you don't get swept up in the excitement. You might sell, or simply do nothing, even if everyone around you is celebrating. Intrinsic value becomes your anchor. It's the fixed point you return to when the market tries to drag you into emotional decision-making. This is why Buffett can hold cash for years while markets rally. He's not being stubborn. He's being disciplined. He's waiting for price to meet value, and not before. So let's bring it all together. Warren Buffett's mental framework for avoiding emotional investing rests on 5 interconnected ideas. Think like a business owner, not a trader. Treat the market as Mr. Market, irrational, not infallible. Stay inside your circle of competence. Raise your threshold for action with the 20-slot rule. Anchor every decision to intrinsic value and margin of safety. None of these ideas are complicated. Buffett has never claimed they are. The difficulty isn't understanding them, it's applying them when your phone is flashing red, your portfolio is down 20%, and every financial news channel is screaming that the world is ending. That's the real test. And that's what separates investors who build wealth over decades from those who constantly chase and lose. Buffett once said that the most important quality for an investor is temperament, not intellect. You don't need to be the smartest person in the room. You need to be the calmest. If you found this useful, hit that like button and subscribe. We break down value investing concepts every week in a way that's practical and actionable. Drop a comment below. Which of these 5 mental tools do you think would be hardest to apply in a real market crash? I'd love to hear your thoughts. See you in the next one.